When you're looking at this 15-minute time frame, this is the bellwether time frame. This is where I'm looking for key highs and lows. I'm looking for imbalances like fair value gaps and things of that nature. Yes, I'll look for order blocks, but I'm going to try to stay away from order blocks in this lesson, in this mentorship, really, because I have models that don't even rely on order blocks. Obviously, I'm teaching fair value gap here, and that is the main focus because it repeats. It's an easy pattern. It's there a lot. But I want you to think about how you frame your day. I'm taking you to 8:30. Okay, you're going to put a vertical line there at 8:30. All right, so the equal distance in time in the morning, then an hour lunch, New York lunch, and then an equal amount of time after that, okay? So once we have this, I want you to think of this hour here, noon to 1 o'clock in the afternoon, New York time. That is a no trade time period. I don't care who tells you that they can do this and do that. If you're learning from me, just don't trade during that time, okay? Not even in demo, because just trust me, don't do it, okay? So you have your daily range on an intraday basis all set up and laid out. So these are your boundaries. Your morning trade is between 8:30 in the morning. Why? Because there's news events that come out at 8:30 all the way to noon, preferably around 11 o'clock. I generally don't like to take trades after 11 o'clock in the morning. Now, that doesn't mean I haven't or that I won't. I just generally try not to. I want to try to be positioned before 11 o'clock and hopefully be riding something into the New York lunch at noon. And then, squaring positions or taking some off if I'm going to hold through the lunch and anticipate something going through to the close. All right, so we're looking at prior to 8:30. What are you looking for? But one of the questions I got was, what highs and lows are we looking for that, a stop run would be framed on, or what would be the catalyst for a stop hunt? Well, prior to 8:30, if you look at that, I want you to take a look at the high here. And the low right here. So prior to 8:30, in other words, to the left of that, on a 15-minute time frame, what's the most significant or obvious swing high and swing low? Swing high is this. It's a candle with a lower high to the left of it and a lower high to the right of it. 3-candle pattern, okay? It does not matter if the candles are up or down closes. You're just looking for a swing high, because above that's going to be buy side liquidity or buy stops, and a swing low prior to 8:30. That's a candle that has a higher low to the left and a higher low to the right of it. It's 3 candles. Again, it does not matter what the close of the candles are. It has absolutely no bearing on what I'm showing you here, because the swing points are where liquidity is going to be placed. Okay, so once you have these levels on your chart on a 15-minute time frame, then you can drop down into your first lower time frame for entry. That's your 5-minute chart. So let's do that now. So now we have this old high back here. Look at this price right there. Okay, that's going to be the high price on that particular candle right there. It's 45.14 and a half. This candle trades to 45.14 and a half. Exactly the same high. When we have that, but look closer, we have relative equal high, but we have it in multiple short-term highs that keep going higher. If there's 3 highs that go up like that, that's a classic 3 drives pattern. There's a book I really enjoyed when I was in the 90s, Linda Raschke and Larry Connor's Street Smarts book. And the pattern that she and Larry mentioned in there was the 3 little endings pattern. It sounds quirky, sounds a little silly, but it's basically the 3 drives pattern. Okay, that means it's a swing high, a higher swing high, and a higher swing high. So it's 3 times the market kept pressing up. I like to see this pattern forming when there's an old high back here, okay, on any time frame. It's universal, okay? But if you ever start seeing these 3 drives up into an old high, you don't have to see that 3rd high take out the old high, because what it's doing is it's already pressing into running out liquidity. Every time it creates a swing high and it starts to go down, bears are trying to sell that. And they're putting buy stops rating above the previous high. And they keep getting taken. So it's already building in liquidity. And informed investors, or quote unquote smart money, will be already establishing short positions. Then the market breaks. In one of the previous videos, I talked about the pattern or the setup, and I suggested not using a particular swing low that looks like it's been violated, and why didn't that trade work out? Wouldn't that be a losing trade? I want you to think about this idea that I teach, which is displacement, okay? If you have a children's swimming pool, okay, if you have a children's swimming pool in your backyard and you fill it up, and then you have an elephant just fall down inside of it, what's going to happen? The water's going to be displaced, okay? It's going to be an obvious displacement of that water. Rather simplistic analogy, but that's what you're looking for in price. When price goes above an old high and it trades down below it, you want to see an obvious displacement. You don't want to see it just do like, oh, well, a little lethargic run here. That's not enough. This is like that elephant falling into that children's swimming pool. It's no doubt about it. It really had a displacement. When that occurs, then you go in and you start looking for the fair value gap. The low, the high, and if it trades back up into that, then you can look for a short, okay? There's a process that you go through learning it, and it's good that 3 of you were very critical about it, but trust me, there's rules for a reason, and I'm not trying to hide failure, because these patterns sometimes will fail you, okay? You'll read them wrong, or they just won't work, okay? Sometimes the market will have some kind of a news event that comes out, or it just simply just rolls over top of it and goes higher or goes lower. That's a losing trade. That's why you have to have a stop loss. That's why you have to have good sound money management, because if you don't have those things, Murphy's Law is going to creep in, and whatever can go wrong will. And if you leave it open to the market's determination how bad the pain's going to be, trust me, you don't want that. Okay, you want to limit that. So now we have this previous high, previous low. Now, if we did not, this is really important that you understand this part here. If we don't start seeing these higher highs forming, and it's just one steady run up, then you anticipate a high like this to be taken out. And it doesn't need to be taken out by much. Just trade above it, and then you want to look for this energetic movement lower. That's displacement, where it's really animated. So in other words, it would look like when you're looking at your chart. That's a little bit more pronounced because it went above this previous high here. You're looking at this one, but as it's starting to move towards that old high, remember 830, prior to that, you're looking for, what's this? It done a swing high? Yes. So it's trading above it here. Does it have an energetic break below that? No, it's just a very weak, anemic move lower. Then you have another run higher here. And then you have this wick or tail come down, and it quickly snaps back. Does that create a fair value gap in that? No, it's not there yet. Then it goes higher here, doesn't go above, it matches that high, but then now this high, watch, does it go below that? Yes, a little bit here, but it's a little anemic still. But then look what we have here. It trades up and then smashes down. Then the next candle here closes. What do we have? There's your fair value gap. That's your short. And you could reach for the liquidity resting below that low that you would be identifying prior to 830. So sell side liquidity matching up with your short. You sell, you want to buy it back to cover that short. Well, here's waiting sellers right down here in the form of sell stops. Bam, hits it. Okay. Putting aside that you may not have seen this as a long entry. Okay, maybe you didn't see this as a potential continuation of bullishness. But look at these highs here. What's resting above that now? Buy stops, buy side liquidity. And then what do we have here right before lunch hour? It goes slightly above it and then trades down. And then we're in that time of the day, you don't trade it. New York lunch hour, noon to 1, don't trade it. Okay, do not trade it. It can do a lot of weird things in that hour, or simply do nothing and go sideways. But either way, you don't want to be a participant in that because it's not usually a clean time of day for price action. So now here we have the high of the day and all the liquidity resting above here that would not have been tagged by this. In other words, stops that are resting a little bit above that. Because there's a lot of people trying to sell short. They want to see this thing go lower. But we created a very important low last week, and the market has already tanked a lot. So it's pulling back up in the run that it created, going lower on a daily chart. So all these buy-side liquidity pools here are going to be a reason for the market to want to reach up to that, because you don't have to be a participant down here as a buyer. You just need to know on the other side of lunch at 1 o'clock, start watching and see, is there an indication that this thing wants to go higher? All the buy side liquidity here ran aggressively here, but then the market trades right into the close, aggressively bullish. Small little retracement here, small little retracement here, and then immediate run right into the close. Now, obviously, the market trades a little bit beyond that, but this time of day, expect whatever algorithms that you would expect to be driving price and price runs to pretty much cap the majority of the volume that's going to be in that day. So what I want you to think about is how the day's designed to have a morning move, a lunch hour where you don't want to be trading, and then the afternoon move. Go back through your charts, and you can go back as far as you want. The more you do this, the better you'll get. But I want you to think about creating your charts like this and then describing what the morning trend was. Was it a bullish move? Was it a bearish move? Was it consolidation? If it was consolidation, prior to that part of the day, in other words, the previous day or the previous days, was it bullish or bearish then? Because if it was bullish, this is probably setting up another continuation higher, especially if you start seeing these relative equal highs forming, where it paints the idea that this is retail resistance. So traders are going to think that this is going to go lower. And that starts to build up a lot more interest in the form of buy-side liquidity or buying interest at a high price. Even though that those traders may be framing the context of their trades as a short entry, trying to make money going lower, their protective stop, if they choose to use one, it's going to be in the form of a buy stop. And this is where it's going to be at. So the market's going to want to gravitate towards that, especially if you start seeing the swing lows, not the one in lunchtime, ignore that one. You start seeing the swing lows that are forming. Every candle that has a higher low to the left and higher low to the right, if they start building up and every time they create a new one, it's going higher, that's a underpinning of the marketplace that's showing accumulation. It wants to go up because it wants to clean out all this here. Plus, we've been going up for a few days on the daily chart. Plus, the sentiment is everybody thinks it's been going down, so they all want to sell short because they want to see a stock market crash. But what they are failing to realize is we've already went down below an old low on the daily chart. So now we're running back the other direction, and anyone that's trying to sell short, unless it's a real quick intraday scalp, they're having their clocks cleaned. So in the afternoon, there's a trend, and one of the built-in characteristics of the afternoon is there's mechanisms that are built in that help this market really accelerate into the close. And if you study the price action in your lower time frame charts, you'll see that there's a repeating phenomenon at typically around 20 minutes to 4 and 10 minutes to 4 and 4 o'clock. And it's all based on market on close orders. That's really what it is. Okay. And the algorithms will start spitting out really, really aggressive pricing and forcing traders to either cover or get out of their trades. And usually if it's going up, it really just ramps up and accelerates in that direction. So while I really enjoy trading the morning session because there's a lot of volatility and excitement, if you're looking for, if you know what your daily bias is, and we'll talk about that next week, if you know what your daily bias is, and if you know what you're looking for in terms of range expansion on the daily chart, now what do I mean by that? The daily candle, do you expect it to trade higher or lower? You're not trying to predict, every single daily candle's close, but you're trying to determine, do you think that the daily candle you're looking at forming today, or what would be forming tomorrow, is it more likely to be expanding higher or lower? If it's expanding higher in your analysis, that means you want to try to trade with the expectation to find a trade in the afternoon based on the logic that was used in the morning. So in other words, think about what I taught in Forex. The daily range, okay, creating a initial high of the day and the low of the day here. Now, this is not the time of London, but this would be like what I teach as a London low in a buy day for Forex. This would be the low of the day. Then we consolidate, and then we get the New York continuation, and it runs in the same direction that the London session formed. But this is not London. This is all New York time. So I want you to think about outlining what the session was in the morning, and then what did the session do in the afternoon. Sometimes what you'll see is it'll be bullish in the morning and then reverse in the afternoon. Or it'll be bullish in the morning and continuation higher in the afternoon. And you'll get like a measured move. What's a measured move? Whatever the morning move was, it'll duplicate that twice. So if it moves up 200 points in the morning, the afternoon could see another 200 points in addition to that and have a 400-point range. Or we could have consolidation in the morning session, and then it trends in the afternoon, higher or lower. Then study what the daily chart was showing days before, when it had days that had these nice runs like this, and yesterday and previous Friday. So it allows you to help find these big moves where if you're looking at other, like, I'm not going to say this to try to be mean-spirited because that's not my intent here. You'll see traders that'll get in here like that, and they'll put lots of contracts on and trade this and have a whole lot of hype and anxiety about whether or not it's going to move in their favor and worry about their stop getting hit and all this stuff. And I don't want you thinking like that. Okay, I don't want you thinking like that at all. I want you to think about how, if this day was bullish for you, say you had the benefit of knowing that through analysis you felt that this was going to go higher. Okay, if that's the case, this swing low here, first swing low in the importance after 130. This is really important. 130, I'm looking for swing highs and swing lows for the afternoon session. That's what I'm looking for. It's the same context that I use for the morning session. I'm looking for swing highs and swing lows prior to 8:30. I'm looking for the first one. Okay, I'm not needing to go back days and days and days. I'm just looking for the first one. It's not a complicated thing. But at 1:30, that's usually when I'm wanting to start trading in the afternoon. That's the earliest. But I'm preferably looking for a swing high and swing low to form at 1:30. Why 1:30? Because there's an algorithm macro that starts running at 1:30. That's beyond the scope of this mentorship, but just trust me, there is something going on that creates movement at 1:30 in the New York session, okay, in equity market. So when that occurs, all we're looking for, or what I'm looking for, is a swing high and a swing low. And then that same basis of looking for a stop hunt in the morning, like we described here, I'm looking for the same thing here. That's it, same thing. So now think about this. I'm thinking that these stops are in jeopardy because it's too clean. The level's too clean. Straight line edges in the market, they don't tend to stay like that. There's going to be a disruption. The market's been going higher, hasn't it? Yes. There's this pent up aggression that this market wants to go higher, but it's seeing short-term resistance here, here. It tried it a little bit here, and then retraced inside the lunch hour. The algorithm reserved the price run until later in the day. Now watch what happens. This swing low here gets violated right there. See that? That swing low gets violated right there. That small little stop hunt is all that's necessary. That will start what is called a buy program. A buy program is when the algorithms go into the process of spooling. Spooling is where it just continuously keeps offering higher prices. If it's a buy program, it just keeps offering higher prices. It does not matter what the volume is. It does not matter. And I don't care who you know, who worked at the exchange. I don't care. Trust me when I tell you, if you go through the charts, you're going to see this. But these things tend to repeat. And if they repeat a majority of the time, not every day, but the majority of the time, if these things are in alignment, if they start showing the same fingerprints, it's probably going to pan out. And then you can start doing long entries and then hold for the close. Okay? So inside this area, the market creates a swing low, runs through this low, stop hunt. So the stops below here are what? Sell stops. Buy those sell stops. I know it feels scary, but go through your charts and you'll see many examples of this happening. It's the same thing that took place over here. Buy the sell stops that are resting below here and expect this level to be taken out. Consolidation through lunch. After 1:30 in the afternoon, wait for a swing low to be violated and then rally. What if you don't get a swing low that trades below it? What do you look for? Well, you look for a move higher that's sudden, displacement higher, then look for a fair value gap. If it trades back down to the fair value gap, you buy that. There's your two patterns. That's it. It's the only two patterns you need. You don't need 15 different gimmicky names, okay? You don't need breakers. You don't need an order block. See how easy that is? Very simple strategy. Very, very simple strategy. You have a trade one way or the other, and the logic has to be there for either one of them to form. So let's go over to NASDAQ, and I'm going to save time and not put all the lipstick on the chart. I hope you can allow me that. But here is 130. We have a swing low there, and it's basically almost the same low as that one. So what's happening here? What's that? It's trading down below it. See that? Look further to the left. What's that? Fair value gap. Man, it can't be that easy. It can't be that easy. These relative equal highs, what's above that? Buy side liquidity. Okay? Watch. I'm going to drop into the 1 minute chart. And if you look at this low and this low here, what are those? They're relative equal lows. So that's going to be viewed as what? Support. Retail support. And they're going to buy those little runs here. They're basically going to chase that. So if you look at this through the scope of below this level, there's sell stops. And you think it's going to go higher. Like I believed it was going to go higher today. I want to be buying those stops. All right, so say you're watching price, it's meandering through, and then all of a sudden, that swing low forms right there, and then we have this low here, and then we have this sudden drop down. When you see that, if you're watching it on a 1 minute chart, that's going to look so dynamic, so aggressive. If you're zoomed in, it's going to feel like the floor has just dropped out. But that's exactly what you're looking for to buy. Right there. That low is the lowest candle. It rallies all the way up. Okay? And then right here, that was a close.